With investing analysis on today's healthcare headlines, this is your Market Checkup. I'm Allison Southwick, and I'm joined today by David Williamson, healthcare analyst here at the Motley Fool. Today we've got some deals to talk about and also some bad news for Intuitive Surgical. Let's get started with Shire. Biopharmaceutical company Shire has reportedly beat out several companies, including Sanofi, with its $4.2 billion bid for rare disease company ViroPharma. What can you tell us about this company and the treatments that they're bringing to Shire?
Well, it's a great deal for Shire. It's their biggest deal ever, so definitely transformative for the company. And what they're getting is really one drug, Cinryze. It's for an orphan or a rare disease called hereditary angioedema, HAE for short. And it affects about 18,000 people. It's an immune disorder, and it manifests as sudden and painful, potentially life-threatening swelling of various mucus and skin membrane. So it's a pretty serious disease. The drug itself, Cinryze, nets about produced about $400 million in revenue. It's the vast majority of ViroPharma's profits, and this would complement Firazyr, which is a product Shire has now. Cinryze is for prophylactic use, and Firazyr is to treat these flare-ups. So essentially complementary products, although there's some concern about potential cannibalization, but I don't think that's too much of an issue.
So it sounds like there were quite a few companies bidding for it. Like we said, Sanofi got outbid. So why are rare disease companies like this one so hot right now?
High prices and a lack of competition. I mean, it's really a monopolist dream. It's tough to make drugs for these rare diseases. When you do, you generally get market exclusivity. There's not a lot of competition because of the smaller marketplace. I mentioned 18,000 for this disease. You look at some disease, it may only be 3,000, 4,000 type of people. So, it's often seen before legislation changed, it was often seen as not worth it to produce drugs for these treatment areas, but these are serious conditions. People need treatment, and if you have a drug, you can sell it at a pretty high price and make good profit while really helping a patient population.
All right, let's move on to our next story. A new report is out showing that Intuitive Surgical's Da Vinci system is linked to an increase in injuries and in the rate of deaths since 2004. The company argues, however, that there has not been an increase in death rate and the injury rates fluctuate. So how bad was this report? I mean, is it bad as it kind of sounds on its face?
Well, it's sort of a continuation of a theme that we've seen, and it's nothing that investors weren't already hearing, so that's why shares really aren't down today. But it is concerning because, Intuitive, the doctors that were polled, there was only a handful of doctors, so it wasn't really enough to say, okay, this is a statistically significant survey. But it weighed on both sides, right? Because they argued that the results of the Da Vinci process were shorter recovery times, and less complications overall. But they also said that training, which is usually that's what Intuitive argues, but its detractors argue Intuitive puts sales over safety, and the concerns were that there wasn't enough education and training being done, and that's where you run into problems with these devices. Again, there's nothing groundbreaking here in today's news, but it's more of that dark cloud that's been hanging over the stock, and the stock's really been down about 30% since we've seen these reports come out. So it's been tough sledding for Intuitive Surgical shareholders.
So it sounds like really not something investors should be concerned about, or is it something to watch?
It's definitely something to watch. I mean, they're facing over 50 lawsuits right now, or around 50 lawsuits relating to injuries to the Da Vinci device. And we don't know if this increase in reporting is just because there's brought more attention to it, and we've seen how reports are changing as far as negative incidences. I think the real concern too is when I looked at their most recent quarter, benign hysterectomies, which are a disproportionate amount of their utilization, really decelerated that growth, and so that could lead to increased capacity, which could then hurt system sales. I do think it's going to be tough sledding a little bit for Intuitive Surgical in the meantime until they can get past some of this overhang from the FDA, from the lawsuits, and until they can potentially get some tailwinds behind them, whether that's growing into general surgery, which they're going to do, international growth, which is a big avenue. So I think the long-term story for Intuitive Surgical is bright, but I think the short term in the next year, it could be a little tough.
All right, well, let's move on to our last story. Novartis announced that it is shedding most of its diagnostics business to Grifols, a Barcelona-based company. This is part of Novartis' broader strategy, which we've talked about in the past, to focus on businesses that can scale to compete globally.
Yep.
And apparently, blood transfusion diagnostics just did not make the cut. What did you think of this sale?
I thought it was great for Novartis. I mean, this is, we just filmed on them potentially ripping themselves apart, and it looks like, they move quick when they see an opportunity. They sold it for $1.7 billion to Grifols. This did roughly $640 million in product sales with another $100 million in royalty revenue, but that royalty revenue goes away in 2016 when some patents expire. Novartis was a market leader in NAT diagnostics that test blood for disorders like HIV and hepatitis C, West Nile. They do run the deal in partnership with Hologic, and I don't think this divestment should change that for Grifols. I think it's an interesting acquisition for Grifols as well. They are in a similar space, but there's not too much overlap, so they really are expanding on their focus. I don't know how much synergies there'll be, but it looks like they paid a pretty fair price.
What can you tell us about the strategy, the broader strategy so far with Novartis? Do we know what they're going to hold on to? What other things might be on the chopping block?
Yes, we definitely do. I mean, they've made it pretty clear that animal health is on the chopping block. Diagnostics, which they just chopped, right. And vaccines, which was a little interesting because this is a company that was known for its vaccines, and there's some debate because I've seen projections that vaccines could be worth around $6 billion in a sale, which is a nice chunk of change. Other analysts are thinking, perhaps they could fold that into the pharmaceutical business and use it for maybe some more immuno-oncology development using their vaccine technology, and they do have a blood cancer immuno-oncology program called CART, which is further back in development but really interesting. But their pharmaceutical businesses did $33 billion in sales. That's completely safe. Alcon, their eye products, did $10 billion in 2012 sales, also completely safe, and they're a big market leader there. And Sandoz, the generics unit, did $9 billion in sales, and that's an interesting growth avenue for the company as well because they're going to go after biologics, which is generic biosimilar type drugs, and so there really aren't a lot of those out there right now, but it's a way to essentially make a generic version of a really tricky asset, but still charge a premium-esque price because it won't be as such a cutthroat generic competition as you see on normal pharmaceutical products. The divisions they're looking to get rid of, vaccines and diagnostics together did $2 billion in sales, and animal health did $4 billion. So when you're comparing $2 billion and $4 billion to pharmaceuticals, which was 33, I mean, we're definitely talking about their smaller units. I think they're trying to correctly focus in on what they're good at and really produce great results there.
And you mentioned their oncology drugs. We did get another piece of from Novartis, another piece of news today that the company has licensed a cancer drug from Immunogen. What can you tell us about that drug?
Well, this will be just another collaboration with Immunogen. They have some before, and this is licensing Immunogen's technology. It's an ADC platform. Immunogen and Seattle Genetics both have these, and they've both really licensed them out to Big Pharma to develop drugs. And we've seen some drugs come to market. Roche has one with Immunogen. So it's definitely good news. And it's really good news for Immunogen, which suffered a big setback the other week. They had a wholly owned cancer drug using their own technology that failed in clinical trials, and the stock went down 20%. And I think a lot of people were concerned that maybe Immunogen's technology wasn't that good, but if even after that failure, Novartis is willing to go in and do another collaboration, I think it just shows what industry insiders think about Immunogen and their platform.
All right, well, if you are looking for more investing ideas when it comes to the world of biotech, you'll want to check out our special report. It's called 2 Game-Changing Biotechs. You can get a copy by just emailing us at biotech@fool.com. For David Williamson, I'm Allison Southwick. Thanks for watching.